Hi, my name is John Alzheimer, and I am a credit expert who contributes to creditcardinsider.com. Today's question was actually submitted to creditcardinsider.com by a reader, and if you have any questions regarding credit, then please feel free to submit them and we will address them in future YouTube videos. The question is this. I have applied for a personal loan with Discover. Discover now does personal loans, by the way. They're not just a credit card issuer. And Discover has requested verification of income in the form of a W-2, a pay stub, and a bank statement. Is this a legitimate request, as I am very uncomfortable providing this information? So I definitely understand your trepidation giving out such sensitive information. However, Discover and most other lenders use that type of information for a variety of reasons. First and foremost, they use that information to determine whether or not you have the capacity to pay back a loan. Now, this is very, very different than pulling a credit report. There's actually a variety of measurements that are important to lenders before they will underwrite an account for you or approve an account for you. One is the measurement of creditworthiness, and of course that's accomplished by looking at credit reports, credit scores, and then using that information to determine what type of credit risk you pose to the bank and whether or not they want to give you credit based on the type of risk you pose. Low credit score, high risk. High credit score, low risk. You're going to get very different types of reactions from the bank depending on where you fall along that risk curve, if you will. Whenever a bank is asking for things like copies of paychecks, copies of bank statements, copies of brokerage statements, W-2s, 1099s if you're a contractor, then they're looking to verify forms of income, and this is why they're doing it. They're trying to determine if you have the capacity to pay back something on time, whether a credit card or a personal loan. Capacity is a completely different measurement than creditworthiness. Capacity is your ability to make a payment, where creditworthiness is whether or not you're likely to make a payment. Capacity is whether or not you have enough money in your account in order to do so, or if you make enough money in order to do so. I'll give you a very, very good example of how capacity falls in this measurement process. If I have a VantageScore credit score of 800, that's a fantastic credit score. I'm going to pay my bills on time. However, if I'm applying for a loan that requires me to make a $1,000 a month payment, say for example for a car loan or for a mortgage, but I only make enough money to afford a $500 a month payment, it doesn't matter how good my credit score is, I don't have the capacity in order to make that payment, and I'm very likely going to get denied or get some sort of counteroffer from the bank. That's why they're asking for this type of information. They want to verify that you have the ability to pay them back, because that's as important as whether or not you're going to choose to pay them back when the bill comes in the mail. Another possibility is if you are actually applying for a credit card with someone like Discover. The Card Act now requires credit card issuers to verify your ability to pay or your income or capacity. And for example, if you're under 21, the Card Act requires proof of income or proof of capacity before you can be legally issued a credit card. So there are a variety of new requirements that have been placed on credit card issuers and other lenders requiring that they get proof of income in order to, that you'll be able to make your payment so they can extend a loan. In the past, there was no requirement of income provision in any form of law. It was just a decision that a lender made. They could choose to verify components of your income, or they could choose not to verify components of your income. And I can tell you that in many cases, they didn't. If you think about how mortgage lending was done many years ago, you had these so-called liar loans where people would actually make up their job, make up their income, and as long as they had decent enough credit, they could get a loan. Today, that has changed, and lenders are becoming much more sensitive to people's ability to pay, which is why you're likely being asked for that type of information. As far as handing it over to them, I'm not sure I'd feel too concerned about that. They are a bank. In almost every lending scenario, you're going to have to provide some sort of proof of income, so that's not really atypical what they're asking you for. If you have any other questions pertaining to credit or other financial topics, then please submit them to creditcardinsider.com or in the comments section below. Thanks a lot and have a great day.